Let's start with a statement of changes in equity. And before we start there, just a reminder, creativity is great, but not in accounting. An optimist, the glass is half full. A pessimist, the glass is half empty. An accountant, how much did the glass cost? So remember that is us there. Good. Let's go back to the statement of changes in equity. What do we have to record in the statement of changes in equity? Well, obviously, let's start with this one. For each component in equity, a reconciliation between the carrying amount at the beginning as well as at the end of the period, separately disclosing each change. So each and every item that is a component of equity will be reflected in the statement of changes in equity. It will start off with an opening balance for each and every component and a total. And then all the movements that took place in each and every item which form part of equity needs to be disclosed for the current financial year. Now, what type of items are we talking about? Now, we're talking about all transactions with the owners in their capacity as owners, showing separately contributions by and distributions to owners. So what does it mean in plain simple English? That means if they have put more capital in the entity, I have to show that. If it is a company, and in our case it will be a company, if it's a company, how are they going to invest more capital in the company? They are going to take up more shares in the company. So the company is going to issue shares to those shareholders. So all share issues have to be accounted for during the course of the year. Now, distributions to owners. Now, the first thing that we distribute to owners is dividends. So dividends is a portion of the profits that was made for the year, and then we declare a dividend to the shareholders where we give them a portion of those dividends. Another type of distribution that can be made to our shareholders is a capitalization issue. I'm not going to dwell into that now. We're going to do a lot of that when we do companies. So when we do companies, we're going to do in any case statement of changes in equity in detail. So then you will see exactly what we're talking about. We also said that we have to do an analysis of each item for other comprehensive income. So the only one that you are going to do is the revaluation surplus. And we've already told each other that the profit after tax will be added to retained earnings, which is also a component set out in the statement of changes in equity. And the other comprehensive income will be the revaluation surplus, which will be recorded under revaluation surpluses. Also a component of our statement of changes in equity. Creativity is great, but definitely not in accounting. A guy's an optimist, his glass is always half full. A pessimist, his glass is half empty. But an accountant is only concerned with how much the glass is costing. Let's have a look what a statement in changes in equity looks like. Each one here is a component of our equity. So one component is our share capital that we've issued. So there we will start with our balance at the beginning of the year. We will add all movements that took place during the year. Now, in this specific example, there was no shares issued. But if there was shares issued, you would have had a share issue here. And obviously, it would have increased the value. Oh, here it is. Issue of share capital. It would have increased the value of our share capital account. Now, look here. We have to give comparative figures. So we start at the beginning of 2018. We work up to the end of 2018. This was for statement end of 2019, and then we will do the current year and we will close off with 31 December 2019. Why? Because we have to give comparative figures. Now you can only do that in the statement format by starting at 1 January 2018, get a balance as at the end of 2018, then work forward with the movements in the current year and close off with a balance at the end of 2019. Now when we're going to do the statement of changes in equity, you will see that we will always start year, the opening balance as of the current year, and we will only do the current year's movements. But remember that the actual requirement is that we have to give comparative figures, and we actually have to start in 2018 and work down to the end of the current financial year. Share premium, don't break your head about that now. We will deal with that. Preference share capital, it's also a form of capital. Don't break your head there. Just know that we will have to, if we have issued, we will have to add it to preference share capital. Retained earnings, we said it will be our profit for the year, will increase it. And if we have paid dividends and if we declare dividends, it will decrease our retained earnings. You see that we have one line item here for total comprehensive income. Now that is our net profit after tax. Our other comprehensive income will be recorded under our revaluation reserve. So therefore that both of them forms part of total comprehensive income. So if I add that one with my profit, it will be my total comprehensive income as per my income statement at the end of the year. Good. So at the end of the day, I'm going to get for each class of equity item a closing balance. And on the face of my statement of financial position under the equity section, I will have a line item for each and every one. So under equity, I will have ordinary share capital with a total, share premium with a total, preference share capital with a total, retained earnings with a total, and revaluation reserve with a total. And if I add it all up, it will balance back to my total there, according to my statement of changes in equity, and that will be my total equity in the entity. Notes to the financial statements. Now, the statement of compliance with IFRS. Now, the first note is our accounting policies, and that is very important so that we can see on what basis our financial statements are prepared. And then any additional information useful to the users of financial statements in order to understand what is happening there, what is the information that they have disclosed in order to enable them to make any decisions thereafter. So they can actually evaluate the entity's returns, their objectives, their policies, the way that they're managing capital and resources of the entity. So it's very important that we have notes to the financial statements which explains exactly what it's all about. You can look at this, what an accounting student, this one, what my friends think, what my mom thinks. Yeah, I think that was definitely my thoughts about my kids. What society thinks, what my prof thinks. Yeah, it's a bit difficult under current circumstances, but I'm sure if I want to make a plan, I can. What I think I do, very conscientious, what have you, and what I actually do, suffer. Reporting period. Accounts presented must be at least annually done. If it's longer or shorter, the entity must disclose the fact. Now guys, who said accounting is stressful? This guy's only 35 years old and he feels great. Let's have a look for the example of accounting notes. You have to write once more a proper heading. ACCC 121 Pty Limited, notes for the year ended 31 December 2020. Accounting policies. And guys, you have to know all these accounting notes because the only stuff I haven't put in anything that you are not supposed to be able to write. So I can ask you anything of these and you have to be able to write all of these accounting policy notes should it be required. Okay, so I've said here the following are the principal accounting policies of the company which are consistent in all material respects of those applied in the previous year except as otherwise indicated. Very important because we've seen that this is part of the general features of financial statements. Consistency. 1, rounding. All amounts are rounded off to the nearest rand. Basis of presentation. Financial statements were prepared on the historical cost basis except for land and buildings that are revalued and financial assets that are shown at fair value. So whatever the case might be, there's a smaller little typing error. So whatever the case might be, if I do not apply any revaluations, then obviously that is not applicable. Then you will stop there. The financial statements were prepared on the historical cost basis. Full stop. It is only when we apply the revaluation method on certain items that we will continue and say that there is an exception. Property, plant and equipment. Now this one we've done already. Property, plant and equipment are stated cost less accumulated depreciation. Other than freehold land and buildings on which depreciation is not provided, depreciation is recorded by a charge to the income statement, computed as the right of the cost of the assets over the expected useful lives. The rates are as follows, and then for each and every clause, you have to give the depreciation policy. Inventory. Inventory is stated at the low of cost or estimated net realizable value. Cost is calculated on the first in, first out basis. Estimated realizable value is the estimated selling price in the ordinary course of trade, less any compulsory cost to be incurred to make the sales transaction happen. You know this note. Allowance for credit losses. The allowance for credit losses is based on the expected impairment of debtors based on the discounting of future cash flows at an appropriate rate. You know that you have to write this. Your note didn't look exactly like this one. You would have said that the allowance for credit losses is created each and every year based on 5% of outstanding debtors or 10% or whatever it is. Revenue. Revenue from sales is recognized when risks and rewards of ownership have passed. And here's our property, plant and equipment note. This is our IAS 16 note, the opening carrying value, the movements for the year, the closing net carrying value for each class, and a total column. Then you also have to say where land and buildings are situated, that you also know. And if it has been revalued, what was the effective date of the revaluation and who has done the revaluation, that you have to mention as well. And then it is the policy of the company to revalue land every how many years. And then you also have to tell the reader what is the methods and the assumptions which was used in estimating the fair value. If the property was not revalued, the carrying amount would have been XXX. So that you also have to disclose. If you did revalue the property, then you must say what the original carrying amount of the property would have been if you didn't use the revaluation method. Okay. Notes for the year ended 31 December 2020, financial assets. Whatever your financial assets are, money market investment at amortized cost, share investment at fair value, whatever your financial assets is, we've done listed investments, investments in listed companies, unlisted companies, things like money market investments, fixed deposits which have expiry date longer than 12 months after the financial year end, and you know that you have to disclose that year. Inventory consists of finished goods, consumables, work in progress, and raw materials. What was actually omitted here is if there was a net realizable value adjustment, you have to mention that, and you have to mention in your profit before tax note, you actually put in the amount. Trade and other receivables consists of trade receivables, prepaid expenses, creditors with debit balances, less allowance for credit losses, less allowance for settlement discount. And now this is a new one. Take note that you also have to give the reader the movement in the allowance for credit losses. So you will start with your balance as at the beginning of the year. You will tell either if I increase the allowance, which is an impairment of debtors, or if I have utilized the allowance amount, then it will be written off against debtors and the balance as at the end of the year. Cash and cash equivalents, we've also done this one in the past, and please note the comparative figures each and every time. It consists of my current account and cash on hand. It could have been money market accounts, anything which has a fairly short-term liquidity value. If the company has an overdraft, then you know that the overdraft is shown as a current liability and you do not deduct it from the asset figure. So that figure, the total of the actual cash and cash equivalents, which is an asset, will be shown as current assets. If there was a bank overdraft, the bank overdraft will be shown as a current liability. However, in this cash and cash equivalents note, If I have an overdraft, I have to mention what the overdraft facility is, with what bank the facility is, and what the interest rate on the overdraft is. Now this is very important, share capital, and we're going to do this in greater length when we come to companies. Also comparative figures, I have to show authorized share capital and issued share capital. Now park that for the moment. We will going to do this in more detail when we get to companies. Long-term borrowings, we've done that before, interest-bearing, the loan bearing interest at so much, secured by a mortgage loan of the company's pre-owned land and buildings, of a carrying value of whatever, and repayable in monthly installments of so from that date onwards. The loan is obtained from XX Bank, and we're going to transfer the short-term portion to current liabilities. Trade and other payables. Trade payables, dividends payable, income received in advance, accrued expenses, whatever that line item is made up with, I have to show. Now guys, here's our profit before tax note, and there are a number of items that you have to study. You have to study this note so that you know which items are you supposed to disclose and which items not. You do not disclose all income items and you do not disclose all expense items. In a test exam, if we ask you the profit before tax note and you give me unnecessary information, i.e. items that should not be disclosed, it will be marked negatively. So for every item that you're going to put into that note which should not be there, you will deduct some marks from you, either half a mark each or 1 mark, depending what is the nature of the question. Good, so the profit before tax note, profit from operations is arrived at after taking the following into consideration. Again, comparative figures. Income. You have to show the profits on the disposal of any item of property, plant and equipment. You have to show and disclose the profit with the sale of any investment, and you have to show any rent income. Under expenses, you have to show auditors' remuneration. That is what we pay the auditors to perform certain tasks for the company. Now, under auditors' remuneration, you have to disclose separately what was audit fees. Now, audit fee you pay in order for the auditor to express his opinion on your financial statements. So he has to give you audit opinion. It has to be incorporated in the auditor's report, and the auditor's report is attached to the set of financial statements which is disclosed to the general public. Good. So audit fees is to conduct an audit. Other services. Now, in many instances, the auditors also perform consultation type of services to the entity. Maybe they help them looking at systems, maybe there's something specifically that the company wants them to look at. So that would be other services, and I have to disclose that separately from the audit fee. The audit fee is just pertaining financial statements. If I have reimbursed the auditors for certain costs that they have incurred, now that usually you get when you are at a remote location, for instance, and it is required from the auditors to stay over in a guest house or a hotel for the period of the time that they conduct the audit. Then the company is going to bear the cost of the accommodation, but that is not going to be included in the audit fee amount. That will be included in the costs. The client is also responsible for reimbursing the auditor with traveling costs. So that those traveling costs that they're going to pay the firm, that will also be then disclosed separately as costs and not as audit fees. So auditor's remuneration has to be broken down in these 3 components. Depreciation. For each and every class of non-current asset, I have to show separately my depreciation for the year. If there were changes to an estimate during the year, then let's say, for instance, there was a change in estimate for vehicles, then you're going to show it like we've done already, depreciation vehicles. There's a total depreciation, and you have to split it, made up by original estimate and change in estimate. And if there's something applied, let's say, to equipment, then you would have had depreciation, equipment, original estimate, change in estimate. So it applies to all classes where a change in estimate took place. Now, we've said that we have to disclose profits on the disposal of property, plant and equipment, but simultaneously we also have to disclose losses on the disposal of property, plant and equipment. I just want to show you something, guys, that we do not in the income statement anymore make any distinction between income and expenses. But in our profit before tax note, though, for the items that we have to disclose, we have to make a distinction between income and expenses. Right, if there was loss on the disposal of PPE, then you have to tell me exactly on what class of property, plant and equipment did we made a loss. Professional fees paid. Now again here we have to break it down in admin type of professional fees, managerial type of professional fees, secretarial or technical. Now admin will typically be if somebody comes in, let's say that there is a huge mess on creditors reconciliations and they get people in order to come and do the creditors reconciliations, identify the problems, etc., etc. That is of an administrative nature. So that professional fees that we're going to pay these people, that will be classified as professional fees paid admin. Managerial, in many instances you also get, let's say that there is a project that you want a temporary project manager for. You get companies that actually specializes in project management, so you're going to employ a person on a temporary basis to fulfill the role of a project manager. So the money that you're going to pay this person is going to be a professional fee, but of a managerial type of nature. Secretarial professional fees paid. Now that will be for the company secretaries, which is not necessarily employed by the entity. And that will be to keep the share capital records up to date, to take notes, all kinds of additional work that the company secretary is performing. Now, if I pay professional fees to that company secretary, it will be disclosed here. Technical professional fees, well, typically if I have some IT projects that's running in my entity, and I'm paying this outside IT company to come and do this work, that will be of a technical nature. I have to disclose separately lease expenses. That is when I lease, let's say, the photostat copier machine, whatever I'm going to pay as lease charges for the year, I have to disclose that separately. Employee cost, and now you have to show employee cost. What is, and we don't call it salaries and wages. Look at the words. The words is employee cost. Now that can also include things like bonuses. It can include fringe benefits paid out. It can include special amounts that's being paid to our employees. So it's not necessarily only salaries and wages. What is important that all costs that we have paid our directors is not included in employee cost, but it's included in directors' emoluments. Now, all amounts that we're going to pay our directors, we have to split and we have to distinguish between which were paid to executive directors and which were paid to non-executive directors. Now, an executive director is typically somebody that also is involved in the day-to-day business activities. Like, for instance, the financial director. He is also performing the role, he's got a full-time job at the entity that you're going to report on, and he fulfills that role on a full-time basis. So therefore, he's an executive director. A non-executive director is typically somebody that only attends the board meetings, the board of directors meetings. He gives his input there, but is not actively involved in the day-to-day operations of the entity. All companies have non-executive directors, big companies have non-executive directors because they make use of their knowledge and skills that they have and background that they have coming from experience with other companies or similar type of companies, which they can bring to the table and make sure that they have a positive contribution to the management of this entity. Now, under each of them are the executive director actively involved in the company's affairs. There we have to distinguish again for services as directors and for managerial services. Now, what is a service as a director? Now, that is mainly for attending the board meetings of the directors. And they're getting paid for that. And some people make that their living. That's all that they do. They are acting as directors on several boards, and that is their mainstream income. So for services as director, just for attending the board of directors meetings, they are remunerated, and I want that cost separately from managerial services. So coming back to the FD again, the financial director, he will get something for attending the board meeting, and that will be disclosed in that line item. And then he will also get his monthly salary, and that will be included under managerial services. Now, the same thing applies for non-executive directors, for service as directors, for attending the board meetings, and for any other job that they perform for the entity. If it's of a managerial nature, it will be disclosed under that line item. I have to disclose credit losses actually written off, and credit losses recovered has to be disclosed under other income. Or under income, this is all expenses. Credit losses written off for the year, I have to disclose the actual amount. So if I did increase my allowance for credit losses, and I've used the credit losses expense account to do the counter leg of that entry, that part needs to be taken out of this, because here I only want to disclose the actual amounts written off for the year. Good. Inventory write-down to net realizable value. Here you can see what I've said a bit earlier. If we did a net realizable value adjustment on inventory, the amounts will be shown as a separate line item under this profit before tax note. Okay. Change in estimate. You know what the change in estimate note looks like. So that is, you have to be able to disclose that. Income tax expense. Now, we're not really going to do a lot here. You should know it's South African normal tax for the current year, and if there was adjustments regarding prior years, I have to show that separately. Events after the reporting date. Now, if there were significant events that occurred between the reporting date and the date that the financial statements was authorized for issue. Remember, let's say our financial year ends 31 December. Then it takes, let's say, 2, 3, 4 weeks in order to finalize the financial results and the statements. Then the auditors take, let's say, another month to audit the stuff. So let's assume that our general meeting, that is where the shareholders have to approve the financial statements, only take place at the end of March. So our financial year end was 31 December, 31 March of the next year, the general meeting takes place and the shareholders approve the financial statements. Now they say if something significant happens in those 3 months, I have to disclose that. When will something be significant? If it has an impact on the decision making of the users of the financial statements, then it is significant and then I have to disclose it. Contingent liabilities and contingent assets. Now, contingent liability is there is a possibility that I can be liable to pay something to pick up a liability in the future. For instance, the company is currently involved in a legal dispute with the employee over injury sustained on duty. The company may potentially be liable for damages depending on the outcome of a court decision. No reliable estimate can be made of the amounts involved. So that is the problem. As soon as I know what the amounts are, I must put it through the books. Yeah, I just note to the reviews of the financial statement, look, there's a possibility I'm going to incur some kind of a commitment that I have to honor, and I don't know what the amount is, but at least you are well aware now that something like that exists. Now, the same thing with the contingent asset. The company may potentially receive a payout from a joint action against Madoff Ponzi scheme. No estimate can be made. So I'm going to receive money somewhere in the future. That is a certainty. I'm not sure how much I'm going to receive, so therefore I couldn't recognize it in my books as yet, but I alert the user of the financial statements that something like that is on the cards. Right, the last one is our statement of cash flow. That provides the users of financial statements with cash flow information, all then in IAS 7, which we're going to do later in the year. You didn't have the cash, so you borrowed $50 from your mom and $50 from your dad. So 50 and 50 equals you had 100 Rand or $100. You bought the shed and had $3 change. You gave your dad his $1 back and your mom her $1 back, and you kept the other $1 for yourself. Now you owe your mom $49, 50 less the one that you've repaid, and your dad also $49. So 49 plus 49 equals 98 plus the $1 that you have paid yourself, and that brings me back to $99. Question is, what happened to the additional dollar? So you can go and figure it out for yourself to keep yourself awake. Right, let's quickly look at the cash flow statement. I'm not going to ponder into the cash flow statement because we're going to spend some time doing cash flow statements. Let's just look at the layout, the name of the entity, cash flow statement for the year ended 31 December. And now what is important is that the cash flow statement consists of different sections. The first section is cash flow from operating activities. And there we're actually going to see how much our day-to-day operations, our trading activities, how much cash did that generate. The second section is our cash flow from investing activities. So we cannot make money if we do not have some kind of infrastructure. So our infrastructure is our resources that we use in order to generate income. And that resources are our non-current assets. Things like equipment, vehicles, property, plant, and equipment then basically. And that is what we use. That is the tree from which we bear the fruit, and we sell the fruit in order to make profits. So here is the tree. We want to see how much cash flow went into investing activities. So how much did we invest in resources out of which we would like to expect to receive some future profits in the future. The third one is cash flow from financing activities. If we did invest in infrastructure, how did we finance it? Did we finance that out of our operating activities? Did we finance that out of our financing activities? Now, financing activities is got to do with long-term finance. So the first thing is out of the issue of equity capital, shares. Second thing can be long-term loans. So those kind of activities with a long-term nature, we want to see how much did we receive or paid back out of what was the cash flow in or out from financing activities. Now, what is wonderful about the cash flow statement is that our cash flow, let me just get the previous one. Our cash flow from operations plus our cash flow from investing activities plus our cash flow from financing activities equal our net increase or decrease in cash and cash equivalents. That must be cash and cash equivalents. So a cash flow statement must always balance. It has a reconciliation note, which I'm not going to go into great depth now. And then this is very true. The look that you get on your face when everything balances in all your financial statements. Very chuffed with yourself. Right, clause example 1. Quake Drugs Limited manufactures medication that reduces the aging process in children with Hutchinson-Gilford progeria. During 2020, uncertainties on the effects the medication has on the cognitive function of the brain of the children. Uncertainties exist, etc. An investigation is undertaken by the International Medical Council effective from 13 November 2020. Our company's year end is 31 December, so on 30 November 2020, the Medical Council starts with the investigation. The investigation will continue for a duration of 8 months, so well after year end. And it is concluded that the effect that the drugs have are of a malevolent nature, that if the effects that the drugs have are of a malevolent nature, production of the medication will be ceased with immediate effect. This would ultimately impose on the end of the existence of the company. The company year end is 31 December. Good. It's a lot of uncertainty. We do not know what the outcome of this investigation is going to be. The question is then, if we think about the general features of financial statements, should we prepare our financial statements on the liquidation basis or should we assume the going concern principle? Discuss the assumption in which the financial statements of Quake Drugs will be prepared as of 31 December 2020. Management do not intend to liquidate the company, so it will not be their decision if the company is going to be liquidated. They also do not choose to cease trading, nor are they forced not to prepare the financial statements on the going concern basis. However, the investigation place significant doubt on the relevance of the going concern assumption because it's uncertain whether the entity will continue to exist in the future. If it is concluded in July 2020, that is actually 2021. Oh my goodness. That must be 2021. There you are. That the medication is malevolent, the operations of the entity will cease. If any uncertainty regarding the relevance of the going concern exists, the facts and the circumstances thereof has to be disclosed. So what is now the long and the short of this question or this answer? Yes, there is serious doubt whether this entity is going to exist in the future. But depending on what? Some kind of investigation that we do not have a clue what the outcome of the investigation is going to be. The management of the entity has no intention of liquidating the entity. So therefore, it's not a management decision, has not been taken in order to do so. So what is the best that they can do? Do you think that they should take action and use the liquidation method? I think that's a bit harsh. But what they should do is they must let the reader of the financial statements know that a possibility exists that the company will cease to exist should the outcome of the investigation in the next financial year be that, that this will have serious implications or impact on the cognitive function of the patients. Next example, to criticize. You know what's nice about the IAS 1 questions, if you get a question where you only have to criticize, because it's much easier to criticize than to write long stories. Criticize the disclosure of debtors in the statement of financial position of a business, debtors Department A, Department B, staff debtors, less our long outstanding debtors, plus income received in advance, and at the end of the day, it's 25,010. So this is the debtors note, the note of trade and other receivables. And you can see clearly that this is nonsense. We never disclose Department A, B, and staff debtors separately. We will only disclose one trade debtors figure of 22,010. Less long outstanding, what does that mean? Does that mean there's an allowance for credit losses? Does that mean that we've written off some debt? If we did write off some debt, we only would have showed trade receivables of 20,010. If we had an allowance for credit losses, we would have said less allowance for credit losses and then subtracted 2,000 from the 22,000. Okay, income received in advance. Is income received in advance part of trade debtors? Now, income received in advance, last time I checked, is a trade creditor. It should be part of that trade and other payables note. So that shouldn't be disclosed there. It's got a credit balance in any event. Okay, distinction only has to be made between trade and other debtors. The disclosure is thereof too comprehensive and makes a statement of financial position awkward. Amounts immaterial like 100 Rand staff debtors needs not to be shown separately. Income received in advance is not part of debtors but creditors. In my mind, only 30% of you accountants are any good. And then he replies, what about the other 60%? I hope you're not part of that clan. Remember that those grades are after taxes. Now, well, that could be something that you can remember and tell your parents the next time that you receive your results. Any questions, guys? If you have questions you don't understand, I'm sure a lot of your questions will, a lot of things that you do not know, how we're going to ask that, etc., etc. Well, we're going to address that with a number of exercises that we're going to do.